what result? So $20 of taxable income from operations, what's that going to do to stock basis? Increase, right? Stock basis is going to go from 100 to 120. What's it going to do to AAA? Increase. It's income. It's going to increase it from negative 100 to negative 80. Now we have a distribution, because E&P is not going to be impacted by the taxable income, right? Because the taxable income is S corporate taxable income, not C corporate taxable income. Our E&P won't change for that. So then we've got a $10 distribution. What's our ordering rule? First, it comes out of what? AAA. To the extent you have positive AAA, it is a distribution out of AAA, and as a result, it is not taxable as long as you have basis. So here we have negative AAA though. So it can't come out of AAA. So then what? If we don't have AAA, what's next? E&P, exactly. So this comes out of E&P, the entire $10? Yes. The whole $10 comes out of E&P, which means it is a taxable C Corp dividend. And that's it. Your E&P goes down to 190, and you go to the next year. Is your basis impacted by the $10 distribution? No, it is not. Think about it this way. It's just like a C corporate dividend. When a C corporation pays a dividend, it does not impact its shareholders' basis. It only impacts shareholders' basis if it is a return of capital, which would be a distribution in excess of E&P. Okay? Let's see here now. We got M Corp. Again, a former C corporation, and its shareholder D have the following attributes on January 1, 2007. We've got positive AAA, positive E&P, and D stock basis, all positive 100. During 2007, M Corp distributes property with a basis of 10 and a fair market value of 50. M Corp also distributes $25 of cash to D. Unfortunately, M Corp suffers $175 of operational losses in 2007. What result? Okay. Always start this stuff by looking at the corporation. All right, so what are the results for the corporation? M Corp distributes property with a basis of 10 and a fair market value of 50. Gain or loss on that? Gain of 40, yes. 40 on property distribution. So we got a $40 gain. We've got a distribution of $25 of cash. No gain or loss on that, right? And $175 operational loss in 2007. We've got a loss of $175, which means overall net we have a loss of $135, right? It's a net negative. We'll come back to how that works. That's at the corporate level. We've got some capital gain, we've got some ordinary loss. CGOL. Now let's look at the shareholder, or let's look at the distributions. Shareholder gets a distribution of, let's see, $50 of property, and $25 of cash. So there's a $75 of distributions, right? Okay. So now let's figure out what happens here, because we've got the basics here. All right. So AAA, E&P, stock basis. Stock basis, AAA, E&P. Okay. First and foremost, we do things in the same order, right? And always do it based on what we would do for basis. So what do we do for basis? Income and gain first, right? So we increase stock basis by 40. This is a prop gain 40. AAA? Nothing. It's a net negative, no change. E&P, no change. So subtotal that, we get 140 here, 100 here, 100 here. Next, we do the distribution, right? Okay. What's being distributed? Well, 75. Is that right? $75 is being distributed. So distribution 75. We take that 75 out of AAA, right? Because we have at least 75 AAA, so we go there, and we got nothing here. So the E&P is still there at 100. We have 25 of AAA, and our stock basis is down to 65 of stock basis. All right. And now we say, all right, now the loss, the impact of the loss. Well, we got 175 loss. Well, actually, yeah, we have 175 loss, although we also have the net negative. So remember, we're going to run the 175 of loss through here. And that tells us that something's going to be suspended, right? Okay, so what we're going to end up with is stock basis equals 0. I can't spell. Suspended loss equals, was it 110? Yeah. Okay, stock basis of 0, suspended loss of 110. Let's go to our AAA. What do we put here? Net negative, remember? 135. Okay. A loss can reduce AAA below 0. Distributions cannot reduce AAA below 0. Losses can. So we have a negative AAA of 110. Even though the loss is suspended, the AAA goes negative. Okay. And then we have 100 of E&P left. Okay? Note the distinction between AAA and stock basis. We have a net negative. And all that means is overall net, we have an overall loss for the year. When you have that, you aren't able to increase for the positives first. In this case, it wouldn't have made a difference, but it's okay. It's the same mechanics. Just run through the mechanics every time. In this case, you're still not going to have any dividend treatment, but you're not going to increase for the 40 in the AAA. You're going to net it out here. So the net of these two is this. Okay? And you can always just do something like that. If you did a chart like that on the test, you can always just, NN lets me know, oh, okay, they notice it's a net negative. Always good to throw catchphrases in the test, right? I guess that's a catchphrase. Maybe that's not. Okay, questions on this? A lot of people find this pretty confusing. I think walk through, I would encourage you all to walk through a few examples of this. The examples from the slides, just walk through how it goes. Write it out yourself. Go through the examples from these questions and from the review problems. Go through these and you'll see, okay, this is how this works. Okay? The rules are actually very mechanical, as I've said. Just keep following the rules. And the net negative is just, it's a modification and it only occurs when you have a net negative. If you don't have a net negative, don't worry about it. Okay? Just run through those.
So if we had a distribution in excess of 100, that's
Yep.
this one?
Yeah, you're absolutely right. If we had a distribution in excess of 100, if the distribution was 110 instead of 75, we'd take down the AAA by 100. We have 10 left. That would come out of E&P. And you would say, well, if it wasn't a net negative, I would have had 40 more of AAA. So if it wasn't a net negative, the fact that I had 40 of gain would have allowed me to take the whole thing out of AAA. Even if I had 40 up here and 39 down here, and I end up with a negative AAA. I mean, you can end up with a situation with a negative AAA based on distribution, so you can still avoid taking it out of VNP. But if you have a net negative, you can't do that. You won't end up in that circumstance. Okay.
So if it's not net negative, then you will do the same thing as basis. You just
Right.
put the income on top.
Right, you put
Before
the
the
income up here,
distribution.
you put the 175 down here. Yep, if it was not a net negative, you'd put the income up top, the loss down below.
For AAA.
For AAA, yes. Yes?
So if you had, say, $100 gain in the next year, would that then increase your stock basis to 100?
It would increase your stock base to 100, but then you'd be able to take your suspended loss. It would increase your AAA up to negative 10. Does that work? Y'all okay? Okay. Let's see here, let's look at question 4 here. Corporation Y elects to be taxed as an S corporation on January 1, 2005. Corporation Y was formerly a C corporation and had accumulated earnings and profits of $10,000 on December 31st, 2004. A owns 100% of Corporation Y's stock, which he acquired on formation with a $5,000 cash contribution. Assume the following. So we got results for 2005, 6, and 7. What's the character of the distributions to A in 2005, 6, and 7? All right, let's think through the same basic thing, right? It's just going to be more complex because we've got 3 years worth. All right, so we got stock basis, AAA, and E&P. Our E&P is $10,000, right? Elects to be taxed as an S corporation on January 1, 2005. And we got a $5,000 cash contribution, and nothing has changed with regard to that. Nothing indicates any change. So we get $5,000 of stock basis. What's our AAA account? 0. Remember, AAA starts at 0. Okay, so income or loss from operations, tax exempt interest income, and distributions. And we've got to look at those for each year. Okay, a couple of different things going on here that are important. First off, we know that in the first year we have income, right? It's all income, so we're not going to worry about a net negative or anything crazy like that. We're just going to say, all right, so I've got $35,000 of income, right? So I'm going to increase my stock basis for $35,000, right? 35,000. Okay, so this is income. What about AAA? What do I increase? 30,000, yes. That's one of the important tricks here. Remember that tax exempt interest income, it does not increase your AAA. And then E&P does not change. So we subtotal these, 10,000, 30,000, 40,000, okay? Now we say we have a $15,000 distribution. Well, we got plenty of AAA, and we got plenty of basis. So it looks like it's a return of capital, right? So we'll take 15,000 out here, and 15,000 out here. This is the 2005 distribution. And I get 15,000 there, 15,000 there, and nothing. And so 10,000 of E&P, 15,000 of AAA, and 25,000 stock basis. So our first distribution, return of capital. Okay. 2006, we have a loss of $25,000 from operations. We've got $10,000 of tax exempt interest income, and we have $10,000 of distributions. Well, let's start by, again, look at the stock basis. We'll change from year to year, and so I'm going to change colors to keep track of that. So what do we do to stock basis? We have income of 10,000, right? Do we do anything to AAA with that? No. No change to AAA, no change to E&P. So then we say, all right, so if we subtotal that, we get 35,000 of basis, we still have 15,000 of AAA, 10,000 of E&P. Now what's next? Distribution of 10,000. So how's that going to be taxed? We're going to take that out of the AAA, right? So we got 25,000 of stock basis left. We got 5,000 of AAA left, and we still have 10,000 of E&P. And the distribution, again, return of capital, this is the 2006 distribution. And here's our, and then, wait, what else happens? The loss. Forgot about the loss. Well, we've already considered the loss for stock basis, right? No, we haven't. So we got a $25,000 loss. And so our stock basis is now 0. We've got $25,000 that comes off of this, or we have 15. What do we do with the AAA? 25. Because again, tax exempt interest income does not change AAA. So we can't use that. So we reduce by 25 here. And we have a negative 20,000 AAA. And then E&P doesn't change. Okay, so this is our ending basis at the end of 2006, ending AAA and E&P. Again, end of 2006. Now we go to 2007. We have income from operations. We have no tax exempt interest income, and we have a $25,000 distribution. Yes.
Pause. If there was $1, let's say, capital gain, or they sell an asset and they get $1, that would cause that negative on that because the gain.
On which one? On 2006? Yeah, if on 2006 there was a source of income that wasn't disregarded entirely, it would cause a net negative, yes. So here now we go to 2007, we have, let's see, $10,000 of income, so we should be able to increase tax basis by 10. So it gives us $10,000 of stock basis. We go here and we say, well, we got $10,000 of income. We should be able to increase our AAA up to a negative 10,000. And our E&P does not change. It is 10,000. We have our final distribution of 25,000, right? How is that taxed? Well, part of it's dividend, right? Let's do that. So we know we've got, AAA, no. E&P is second. We have 10,000 of E&P, so we're going to have a $10,000 dividend. That's part of our distribution. We have 15,000 left. We have no AAA. We have no E&P. So what's next? Basis, return of capital. Did our basis reduce for the dividend? No. So we reduced our E&P for the dividend. Now we reduce our basis for the return of capital. ROC of 10,000. So now we've got $10,000, 10,000 more. What's the rest? Cap gain. So our 2007 distribution is in these three components. 10,000 dividend, followed by 10,000 return of capital, followed by $5,000 of capital gain. That's about as complex as it's going to get.
So the final tally at the bottom would be 0.
Yeah. 0 there. Still 10,000 negative here. Because distributions can't push it further negative. And here, 0 E&P. Important and good point. 0 E&P left. Now we're into the simple rules, right? Now our life is easy, and we stop keeping track of AAA because it's annoying. So we just have to worry about stock basis. Everybody's life is easier. We'll continue to charge our clients for it, right? No, we're back to the easy rules at that point. We don't need to worry about AAA anymore because we've got no E&P. All right? And we're an S Corp, so we don't generate E&P, so things are good. That is question 4. Question 4 is a great example of, it's got all the wrinkles you're going to find. Okay, it's got, I mean, clearly under a very complex fact pattern, you can find much more complexity. But here, this is what you're going to find. This is the kind of complexity you find in a class like this. All right? It gives you the wrinkles. Okay. Now we've only done a portion of class 12. So let me see real quick. Hold on. Okay. 1, 2, okay. So what we'll do is we'll cover question 1 here because we've actually covered this stuff in class. Question 2 won't make much sense to cover until tomorrow anyway. So let's focus on question 1 and see where we are. At that point we will have gone over at least everything we've covered in class so far, and then we can maybe ask some specific questions from folks, or you guys can ask me specific questions about it. So let's look at this. So ABC Inc. is an accounting firm with 3 shareholders. Mr. Adams owns 50% of the stock, Ms. Bradley owns 30% of the stock, and Mr. Cook owns 20% of the stock. In December 2006, ABC Inc. filed an S election effective January 1, 2007. As of January 1, 2007, ABC Inc. had $50,000 of C Corp earnings and profits. And ABC Inc.'s assets at that date were as follows. Furniture and supplies, basis of $200,000, fair market value of $150,000. Accounts receivable, basis of 0, fair market value of $250,000. Okay. In addition, ABC Inc. had accounts payable of $50,000 and a note payable to Mr. Adams of $60,000. In 2007, ABC Inc., a cash basis calendar year taxpayer, had the following items of income and expense: had accounting fees collected, interest income, operating expenses, and brokerage fees. Of the $1 million in fees collected, $250,000 of that amount was the collection of the accounts receivable from 2006. The $50,000 in payables from 2006 was paid as part of the 2007 operating expenses. What are the tax consequences to the corporation for 2007? Okay. Well, let's think about this in terms of section 1374. All right. So with 1374, remember the first thing we're going to worry about is at the date of conversion, what is our net unrealized built-in gain? Well, we know we've got a built-in loss in the furniture and supplies, right? We've got a built-in gain in those accounts receivable. And we also have accounts payable of $50,000 and a note payable of $60,000. So overall, if you looked at our assets less liabilities, fair market value, you'd say, you know, assets less liabilities, we'd get the fair market value, which would be, we get $400,000 of fair market value, and we have another 110 of negative fair market value, right? So we would have net unrealized built-in gain. Well, first off, let's go. FMV would be 150. No, 150, 250. We've got less 60 and less 50. And so total, that gives us what, 290? 290,000 is the fair market value of our assets, less liabilities. And our tax basis is 200. So if we subtract off the 200 tax basis, we have 90 net unrealized built-in gain. Right? I mean, in theory, if we were to sell everything for, for its fair market value, what would we get? Well, we would get, effectively, we'd get 290, and we'd pay 200, or we would have 200 of basis. We should have 90 of gain in there. That make sense? Yes.
So any kind of debt would reduce the fair market value?
To the extent it impairs the fair market value, yes. So in this case, the accounts payable, if you look at this is an entire business that's going over. Those are effectively negative fair market value assets. Effectively, what you've got going on is if you were to sell all the assets and liabilities in one lump, you would get the 290 is the value you would get for that, and your basis is 200. So if you look at your 2007, well, actually no, because that would also increase as well. Let me change that. Because even though it does decrease your fair market value, your amount realized would include debts you were relieved of. So this actually isn't 90. Your fair market value is 400, and you have 200 of basis. So you have 200 of net unrealized built-in gain. Because, and the reason for that is, even though those liabilities do decrease your fair market value, your amount realized would be the same. Your amount realized would include the fact that someone had relieved you of a liability. So your amount realized would be the 290 that someone would give you, plus the 110 of relief of liabilities. So your fair market value is still, ultimately your amount realized would be 400 versus the 200 basis. So, in 2007, ABC Inc., cash basis calendar year tax payments said following items of income and expense. Okay, so the accounts payable come into play in another way here. Okay, and the reason they come into play differently is those accounts payable are accounts payable that relate to a C corporate year. Okay, so what's going to happen here is, first and foremost, the accounting fees collected. Well, 250 of the amount of the $1 million you collected is the accounts receivable from the prior year. That's 1374 property. It's property that relates to a C corporate year, so the 1374 tax may apply. But let's figure out how it does apply. Well, first off, we know that there are two significant limitations on the application of the 1374 tax. One is our net unrealized built-in gain. So even though we recovered $250,000 of the $1 million, even though we recovered that, our net unrealized built-in gain was only 200. So at most, the 1374 tax is going to apply to the 200. Okay, that's one point there. The other element we would look at is what is our other limitation. Our other limitation is taxable income. But our total taxable income here is $1,050,000 over $705,000. So we still have positive taxable income. In fact, the taxable income is in excess of $300,000 here. So you wouldn't expect the taxable income as a limitation in this case. All right. We saw that the $50,000 in payables from 2006 was paid as part of the 2007 operating expenses. This is a lot like being able to apply. One of the things that we did cover in the class was that you can apply an NOL. Like, let's say that an NOL carry forward from a C corporate year into this S corporate year from 2006 into 2007. You can take that NOL and you can offset it against your recognized built-in gain. Well, same thing with these accounts payable. These accounts payable relate to a C corporate year. It's a liability that flows through from a C corporate year. And as a result, you're able to offset, to the extent you're paying those, you're able to reduce your net unrealized or your recognized built-in gain by that $50,000. All right. So ultimately, your recognized built-in gain is $250, right? First and foremost, your recognized built-in gain is $250. But your recognized built-in gain is limited to your net unrealized built-in gain of $200. So you apply that limitation, and so you reduce this down to $200,000 because of the net unrealized built-in gain limitation. So you're only required to recognize up to $200. Now you're able to reduce also, and the ordering is important here, by the 50. Because if you didn't pay the 50 until the subsequent year, you wouldn't be able to take advantage of it here, but the net unrealized built-in gain limit would still apply. But since you paid them in 2007, you reduced by 50 more, and 150, so your 1374 tax applies to $150,000. Does that make sense so far? Now think about how does that $150,000, what tax rate do we use? We use the highest corporate tax rate, right? So if we just ballpark it, call it 1/3 to make life easier, we'd say $50,000 of tax. So now we've got to think, okay, it's still an S corporation, right? So since it's still an S corporation, we would still say, all right, I've got income of $1,050,000, and I've got expenses of $705,000, and so I've got $345,000 of taxable income at the S corp that needs to be allocated out. With one adjustment, right? I'd also reduce it for the tax. I reduce it for the tax that's paid. So now I've got $295. That's what's going to be allocated out to my shareholders. $295,000. And I would allocate 50% of it to A, 30% of it I think to B, and 20% to C. I also have now wiped out my net unrealized built-in gain because I've turned all of my built-in gain assets. I only had one. So my net unrealized built-in gain goes to 0. So now I don't have to worry about my 1374 tax going forward.